Joining me now is David Zervos, Chief Market Strategist over at Jefferies. David, I mean, this notion that the economy can be running as well as it is despite the fact that we've had this kind of data coming out with regard to pricing pressures in the economy building up. Is there anything that we should be confused about with regard to whether or not the economy can sustain its upward trajectory in the face of things like pricing pressures?
Well, Dom, I think it is reasonably confusing. I think the storyline on the inflation has been difficult for many of us to digest over the course of this year. We've seen Q2 numbers that were consistent with what we got in the 1970s for inflation. Then we had a reprieve in Q3, and the monthly numbers started to come in very, very normal. And then again, the last two prints, both PCE and CPI, have been back in that kind of scary range again. So, I'm sticking to my guns. I think a lot of this has to do with supply disruptions and continues to be related to the supply disruptions. I think the demand side of the story is really a difficult one to tell with the job market still 4 or 5 million jobs below where we were in Fed 2020. So I'm sticking with that, but I'm willing to watch and I'm willing to learn that maybe there's something a little bit more persistent in this inflation. And that's what Jay told you, Dom, at the last press conference, that risk may be there. He said that risk is small, but that risk is there and they're watching it. And I think that's the important thing for the markets next year is really much more about how this inflation handcuffs the Fed a little bit. And something we haven't really seen in the past decade or so is a handcuffed Fed. We've seen a Fed that really has come to the rescue more often than not.
So David, I'm curious, if based upon what you talked about with regard to supply disruptions being a big part of this kind of approximate cause even for the inflation surge that we're seeing, does that mean that you are calling inflation, dare I use that word, transitory, and that this is all going to work out and that things are going to get a little bit better down the line and that the Fed is going to have options? Or do you think, as you point out, that there is a handcuff situation that the Fed is going to have to do something with regard to this or face the wrath of the markets and the economy overall?
Well, look, the lexicon of transitory and persistent got very heated last year. And I think there's no question in my mind that the inflation numbers will be coming down. The question is when. I think the Fed has put in their SEP forecast a pretty significant drop-off in inflation, a disinflationary forecast over the course of next year and the year after. So it's in there. The question is timing. And the ugly bit, Dom, is actually really Q1. Because if you look at, say, core CPI, the numbers that are going to drop out in January, February, and March are basically flat monthly readings. So the year over year in core CPI, as well as the year over year in core PCE, are likely to look even worse in Q1. And that would be, no matter what happens, that would be even if growth were to disappoint or there was another variant and the like. It's just kind of baked in the data for Q1. It's not until Q2 that we get those big jumpy numbers starting to drop out of the year over year figures. So the optics just look really bad. And I think that's what Jay reacted to. Jay reacted to everybody saying, hey, there's a 6.8% headline CPI. You aren't doing anything. You really should be doing something. And I think that's where they reacted. They did a very good job of pivoting hawkish, taking a little punch away from the bull and not disrupting the market. We got 10-year notes at 1.5. We got record highs in the S&P. The market's not predicting a big change in long-term inflation expectations. Five-year break-evens are basically where they started the year. So the Fed's done a pretty good job of dealing with this, but they have to stay vigilant, and they're not going to be able to do anything kind of nice and friendly if things get messy. And I think that put structure, as I wrote today for our clients, that has normally been there in a risk-off event for whatever reason. It could be geopolitical, it could be virus related. It's just not, it's not there. It's not there the way it's been in the past. And that makes 2022 a pretty tricky place.